Welcome to another interview by Markets Policy Partners. These interviews augment their newsletter that selects news from around the world that either supports or refutes theories about key issues impacting how markets move and how policy is formed. John Fagan, Brendan Walsh, and Bob Dewey spent their careers in institutional investing, and John went on to be the director of the Markets Room in the Treasury Department, where he translated what markets were saying to policymakers and how policies would impact markets.
Hey, thanks everyone for joining. We are really enthusiastic today to have Sebastian Pedro Bea, the president of One River Asset Management, joining us to give us his perspective on the investment landscape. One River has been a thought leader, established itself as a thought leader long ago in how it manages its assets, and the fact that it got into digital assets with a seminal piece called The Case for Digital Assets, which we circulated to our readership in preparation for this discussion, and that we highly recommend people find on the internet. We invited Sebastian on today because One River has attracted some of the most sophisticated investors, including early adopters of digital assets. And we wanted to see how FTX and the crypto winter is affecting the investor confidence among their investors. Sebastian was also the co-founder of Crypto Stamford, which has grown to be one of the largest people networks in the region for those enthusiasts of the crypto world. Welcome, Sebastian. Thank you very much for coming. I want to set the stage. We'd love to talk about 5 topics. The first is we'd love to know your career and how you got to One River. Love to hear the evolution of One River and how it got to be the size that it is, what the strategies are that you employ. Third, how have you navigated this crypto winter so far, and especially the FTX events, multiple events. Fourth, what are your clients talking about these days? What are they asking you? What are they telling you? And fifth, where do we go from here? What are your predictions? How are you all positioned? And with that, take it away. Thank you so much for coming.
All right, well, thank you again, Robert, and thanks everyone for joining Crypto Mondays Stamford. For those that are in the tri-state area, the first Monday of the month, usually we have the largest meetup of people that are in the crypto industry or interested to be in the crypto industry, including Jerry Brito, who came up from Washington, D.C., and that was right in front of the executive order that was obviously kicking off, I think, a big interest from institutions earlier on this year, which feels about 4 years ago at this point. For those that are around in December, December 5th is our next Crypto Monday Stamford, and this will be appropriately named the Crypto Winter holiday party, because we're obviously in crypto winter. Robert, so in terms of my path into One River, maybe I'll just talk a little bit about One River quickly, and then tell you how I ended up there. So One River is a institutional asset management firm that focuses on basically helping clients prepare for change. That's really what we do in the end of the day. If you look at our various products across volatility, trends, systematic sorts of investment strategies.
What are your assets under management?
So One River is now $2.5 billion, probably headed to $3 billion by the end of the year, and our clients are global institutions from Australia to the UK to the US. We're built for change. We're the type of firm that you trust to build strategies with good risk management. And most of what we do is really deliver risk mitigation. So when traditional risks like equities or rates don't perform, you're hoping that the things that you've invested in with us will in general be unassociated with those declines, or maybe even produce convexity when you need it most. And that's been a big source of our growth. And being prepared for change is really where the firm was started back in 2013. Back then, it was about building customized portfolio ingredients to deliver to clients what they didn't have in their portfolio already. That started with customized funds that eventually led into these more useful ingredients that are commingled products. But at the end of the day, the mission is still the same. And that's how we ended up in crypto back in November 2020. I'll come to that in a bit. Now, how did I end up at One River? Well, I was a happy and busy employee at BlackRock in the systematic active equity business, which is about $150 billion asset manager based in San Francisco. And I'd been working for the group for 6 years and been associated with them one way or another since the start of my career, actually back in May of 2001, when I started at Credit Suisse First Boston, when everybody still called it that. So dating myself. But I was at BlackRock and things were going quite well. We had navigated the difficult period for for quant equities in 2019, 2020, and that was great. But I had a neighbor who was telling me that something was changing, and it was actually his name was Eric Peters. So Eric was a neighbor of mine, and we would just go on walks with our dogs and talk about markets and talk about big ideas, things that could change how we invest, how we think about investing, which is obviously where Eric spends a lot of his time. And he brought up one topic that really kind of stopped me in my tracks. And he said, "Hey, have you really looked at Bitcoin? Have you really paid attention?" And my answer was no, I had not. And the reason is, in my mind, if you can just create a cryptocurrency out of thin air, then you could create 2 or 3 or 10,000 or 18,000. And so I thought the concept of a limited supply asset that you can create with unlimited capacity didn't make any sense. And I left it there. He said, "Well, just suspend those beliefs, because they're just beliefs, they're not knowledge, and read some things." And so he kicked me down the rabbit hole with a bunch of really interesting papers. A fascinating gentleman, John Pfeffer, wrote something back in 2017 that I'd recommend. And so I started my way down the rabbit hole like others did, looking at Bitcoin and thinking about the confluence of monetary policy and fiscal policy, and what was possibly to come. And that was how I started. So it wasn't long thereafter that One River had delivered during the March 2020 COVID crisis. It was clear that Eric was going to need a lot of help in his business, and the crypto thing then happened at One River when we were trying to help a client prepare for what the monetary and fiscal policy could mean. And that's when we became we put on the largest trade ever for one institutional investor. We bought $600 million worth of Bitcoin and Ethereum when Bitcoin was around 15,500 and Ethereum was around 425. That was last cycle. So Robert, I know we kind of danced around. I didn't even get to the sports background. We could touch on that next if you like. But that's a little bit about the firm, a little bit about how I ended up there, along with something that we did earlier on in crypto.
What are the securities that you use and the tactics that you deploy to create this risk mitigation and this convexity for your clients?
Sure. Yeah, at a high level, we have been building products that help the overall portfolio perform better. So this has been a great year for us, right? Equities down big, bonds down big as well at the same time, when there wasn't a single risk model or strategic asset allocation correlation assumption that was calling for it, right? So this has been the type of environment where we've done well for our clients. We have trend funds, so long short products that use futures to buy futures that are going up and sell and short futures that are going down. Those strategies have done well. Some parts of our long volatility complex have done well. Other parts have struggled a little bit with the underreaction from the VIX this year. But in general, what we're doing is we're using these key ingredients to deliver better convexity to institutional client portfolios. There's a product or strategy we've coined the risk responder strategy, and it is the type of thing that really has helped clients understand how they could use us. It's a product that can deliver both in the first response to risk, which is a sharp decline in markets. It has a long vol component. And then it has the second response to risk, which is a slow, steady bleed of equity pain. It has a couple different trend components that respond to that. So that's been a really great story with clients, and it's a product we launched with a partner that's done very well. But in general, that is a product, but it all comes from the same place, which is what are the issues that clients have kind of unresolved in their portfolios, and how can our knowledge of volatility markets, of futures, forwards, and swaps, across global kind of CTA markets. How can we use those ingredients to create better outcomes for clients? And so in terms of our clients, they're, as I mentioned, we've got clients in the UK, we've got clients in Europe, we've got clients in Australia and North America. But in all cases, they think of us as providing, a better way to deliver convexity. And then in some cases, we've got some higher alpha products that help to pay for some of that bleed in more quiet times.
That sounds like a product that was ideally designed for what we've just gone through over the last year. So it also sounds like it's designed to be able to sidestep these failures in the centralized exchanges in crypto.
Well,
I guess, talk about what all that means and how much of a topic is that for your clients? How many people are concerned that the crypto problems can bleed into real markets?
Let me address that. So in terms of our business, about over $2 billion of what we do is in what we call traditional alternatives, right? In hedge fund products. And then about $200 million of what we do is in pure digital funds. So in terms of your question around the failures in the industry, maybe just be very clear. On the One River alternative side, we have a dedicated investment team. They are aware of what these issues are, but they're not distracted by them because we have a separate investment team in digital that just focuses solely on them. So, if the alts investors have a question, that's great. Otherwise, it's kind of for the digital folks to deal with. Number one. Number two, we have separate balance sheets. So the digital business is separately funded. It's public information. We did a Series A last summer. So we're here and we've got the runway to continue to operate during this difficult environment. Now, in terms of your question about bleed over into TradFi, I think this is a really important question because it actually is the question that investors rightly ask in terms of systemic risk, but then completely miss in terms of what's going to happen with regulation, right? So just to slow down and dive in a bit more here, and I think this is one of the most important things that investors can understand about crypto today. Yes, there have been failures of centralized entities with poor regulation, right? That's where the failure has been, whether it is FTX, Celsius, Voyager, etc. That's where we have had the problem. We, as in the industry. Now, specifically for us, we have not had any exposure to any of these issues. We didn't have Luna or Terra in our digital income product. We did not have either in our index funds as well. We didn't have exposure to FTX.com. We're a U.S. investment manager, so that actually shielded us, which is a topic that we should come back to. And we didn't have exposure to the unwind that did impact other investors, whether it's Three Arrows or Celsius, et cetera. So we're completely unscathed from that. And I think but that's, to be clear, that's mostly down to that's down to being a U.S. investment manager, which by definition does actually shield you a bit from some of these offshore entities that lack a lot of regulation. Number two, we've got a great investment staff and operations staff, folks like Jasmine Burgess or Sarah Schroeder or Paul Ebner. They come from places like Brevin Howard and AQR and CPPIB. Now, if you know what that acronym is, then you're definitely in our business. But for those of you that don't, that's the Canada Pension Plan Investment Board. They run about $500 billion. A lot of that in-house, and Paul is one of their members. So the people that we have on our platform did help us to think about and then not go forward with different types of trading strategies that had big operational risk, right? And so that has been great. To answer your question, Robert, what we've seen is, in some sense, we've basically blown up the crypto industry to some degree, right? And has that affected traditional markets? Not one bit, right? And that's great because now, from a regulatory perspective, I think that the path that we have been on becomes even more clear, right? And so what I mean by that is that crypto and traditional markets have been basically operating in somewhat parallel paths with very little actual overlap. The only area of actual overlap right now is in stablecoins, which we can come back to. But in general, crypto and traditional markets are basically progressing in their own paths, parallel paths, with very little overlap. And there have been different ways by which regulatory entities have made that more clear. If you put a bumper sticker on it, it basically would be it's okay to do it in traditional markets, but we're going to make it difficult. That's kind of the summary. And what does that mean? BIS capital rules for crypto for traditional firms are incredibly onerous. They basically make it non-economic for anybody that has to abide by BIS rules to put crypto into their system. The SEC has basically made it very difficult for an ETF to get approved. And in that process, they have also allowed, of course, a futures-based ETF with a very clear rule as to how they define a market of substance and the regulatory regime that would have to be applied to allow for the approval. So essentially to investors, they said, if you want to do it here, we're going to make it tough. And what does that mean? An ETF that basically doesn't meet the needs of most people. And then the most important one that I think people have not understood enough is SAB 121. This came from the SEC. And when it came out, the headline was all about Coinbase and whether, in some remote chance of bankruptcy, what was the risk for the investors, right? Now, that was the focus at the time. What everyone really did not understand was the impact that this had on as I mentioned, the parallel paths between crypto and traditional markets. Because of SAB 121, what it has done has emphasized that crypto and traditional markets are likely to stay quite separate for some time in the US, because it means that if you're a US entity that custodies crypto on behalf of your customers, you need to put that asset on your balance sheet as a liability. And if you do have that liability on your balance sheet and you're a bank, then you have to go look at the BIS and ask, okay, what are the capital rules? Now, just let me back up. Purely native crypto firms do not have to do not follow the same rules as banks, and that's not a value statement. That's just a reality. They're very different businesses. So the effect is that this most recent news has shown that crypto has not infected traditional markets. That's good, but it's also likely to mean that future regulation is going to emphasize this direction, which is continued separation of these two economies and these two market systems for the foreseeable future.
Can we tell yet whether banks will ever be given regulatory relief from SAB 121 so that they would be free to compete in the custody world?
I think the short answer is that nobody really knows. Nobody really knows how this will progress over the next year. But if we had to bet, the number one thing to watch is what happens with stablecoin and the digital bank. That will be the first real meaningful progress point in terms of crypto entering the traditional system. We wouldn't be surprised if that is kind of the beginning and the end of crypto really being integrated directly into the traditional financial system. So we're I guess there are those that thought that SAB 121 stuck out and would be kind of pushed back down through lobbying. The reality is it's not really clear what will happen. But if you had to make a bet, it's most likely the case that SAB 121 will have a harder time, is more likely to survive for a lot longer than those would prefer. And that's because of what we've seen, right? What I mean by that specifically is, obviously BlockFi filed for bankruptcy today. You've seen the FTX and related entities file for bankruptcy. There is a lot of concern about enabling any sort of crossover between traditional markets and crypto markets right now. So those that would seek to integrate crypto into traditional markets and traditional systems and traditional entities are going to see a lot of pushback. I mean, can you imagine if you had your assets custodied at, I'm not going to just say a bank, right? And then that bank, for whatever reason, completely mismanages their keys. And then there is a loss that is a liability of the company, and now they have an equity hole that now becomes a traditional market issue. That's not something that people really want right now. We all recognize the transformative power of crypto, right? We're seeing the risk, right? There is a return, we think, also possible with the asset class. But right now, the focus is on the risk. And when that's happening, it's quite unlikely that we're going to see restrictive things like the SAB 121 be kind of rolled back in any meaningful way soon.
Absolutely.
Yeah, John and I totally agree with that take, especially with the stablecoin. With everything that happened, we're going to have, congressional hearings and things like that, but there's very unlikely that we'll have any significant legislation. but they already started on the stablecoin, and the stablecoin is something, especially as regulators, we understand it's a money market fund. If you say you have a dollar, you just prove that you have a dollar. So it's something we know how to regulate. So that's going to keep going forward, but it's still very unclear how everything else plays out.
Yeah. I mean, when I talked to Marcel Kasimovich, who's our deputy CIO and runs research for One River and One River Digital, he really thinks that stablecoin is the thing to watch as you see. Just understand. Okay, what is the definition of a stablecoin in a regulated bank, right? What is a digital bank, right? What will they be able to do and not do? And at the end of the day, we think it's quite likely that a digital bank will essentially be able to take fiat deposits, but probably be pretty restricted as to what they can do. And without leverage, you end up with a situation of likely having a crypto regulated unlevered, reality, and then a regulated fiat a reality that has leverage, right? Lending. And that's, we don't really know how long this will play out. But I think in terms of, the food fight in most people's mind is whether the CME or the CFTC or, sorry, not CME, CFTC or SEC or, which version of what bill. We think it's much more important to understand the top-down intention of keeping these things separate for now. That will be a bigger deal, that we think then whether, the SEC, their CFTC get, what sort of control. That'll ultimately be a legislative outcome, and they'll just kind of take their direction, we think. But we'll see.
And quite honestly, the regulators are very pleased with what's happening. It means they don't have to do it. The industry is regulating itself in a sense, and the weak hands will, get washed out. And then in a year or two, you'll see how things stand, and then maybe start making regulation. I think it would be a bad decision to rush to make legislation right now on something that we still don't fully understand here in DC.
What's the investment strategy today, and how much does the environment shape that?
Sure. Well, look, from an investment perspective, we are focused on what will work in winter, right? And that means we're not hoping for some environment to change to make the investment strategies we're focused on today pay off for ourselves and for our investors, right? So where are we focused on, or where are we focused right now? Number one, distressed credit. We have the number one asset in the space, which is Bitcoin, right? It is secured by Bitcoin mining, which has increasingly become an American business, right? If you look at the location of hash rate since China shut down mining in their country, that America has become a massive player in Bitcoin mining, and unfortunately, it is also the location of where we're seeing the most distress. So a lot of Bitcoin miners saw great prices and decline in hash rate, so the decline in competition when China shut down. They raised capital, they started to build capacity, and those models were going to make quite a lot of money at 45,000, 50,000, 60,000 Bitcoin. Those models do not make money, they cannot service many of their obligations given the short duration of debt that was applied to most of the Bitcoin mining machines that were bought with borrowed capital. So we have a debt problem in Bitcoin mining, but there's always a solution to these problems. And so we're working actively with a variety of Bitcoin mining companies to try to find capital solutions that can help those with the right power, the right operations, make it through this environment, and then benefit from the future potential recovery. We think it's a unique sort of opportunity in the sense that, you really need to understand distress, which we do from some of our colleagues who work here. You need to understand crypto, and you need to be in the deal flow. And so we're really focused there. The types of potential returns are quite interesting. It's not without risk, of course, but it is an area where there is borrowing demand, as opposed to most of crypto. No one wants to borrow a dollar right now. But in Bitcoin mining, there's a lot of demand. So that'd be one area. Another area that we're focused on is in long-short trend investing. Because of the regulatory environment and all these various tokens, when you really boil it down, this category is really still today kind of a bet: cash versus crypto, and really Bitcoin versus Ethereum. That's where most of the action is in the end of the day. And if you're going to try to access the investment opportunities in the space, you have to really recognize those higher level realities. It sounds interesting to try to be a market neutral player in crypto, but the effective breadth in crypto is actually quite difficult. And when I think about effective breadth, it is looking at the market cap distribution of coins and looking at the borrow availability in coins. And the reality is that market neutral strategies don't scale today. And on top of that, and we've been saying this for a while, they have big operating risk. If you were doing exchange arbitrage and FTX.com was on the other side of your trade, you know what happened. There's a lot of distress that's still, kind of waiting to come out in the papers. We've avoided that in part because we just recognize the realities of the space. So we do think there is a really interesting opportunity in trend because despite all the issues we've seen and all these retail bankruptcy or retail crypto entities that have now run into asset liability issues or worse, the reality is that there's not one investor we talk to who doesn't think that crypto won't be one of the places of the biggest trends in the next 10 years, right? We all recognize that this is a somewhat experimental sector. We don't quite know how all these technologies will impact ideas, assets, music, art, etc. But we all feel it. We all recognize that something big is changing here, and we recognize that these trends that these assets could sell down another 50% easily, but they could also 10x from here. And if you're a long short trend investor, you can still benefit from that. So we're very focused there. We are focused on just the viability of many of these tokens and understanding the fundamentals. So we have something called the Pulse, which is a online system that we use to track fundamentals for over 70 tokens right now. So looking at user count and various sorts of measures of network health. And we measure that pretty carefully, and it was interesting, actually. Network health in general was seeming to get a little bit better right before the FTX debacle, explaining a little bit of the durability of the sector. So those are a couple areas we're focused on. And I think the last thing is, we're working on an SMA, a separately managed account platform with Coinbase. The thing there that I think people forget is, there is a massive technology need to get to enable tokenization of assets, right? Everyone talks about tokenization of assets in traditional markets, but not almost any of them understand the practical realities of that. So what I mean by that is, if you're going to buy a tokenized, a tokenized fund from some private firm, and that's been a big theme recently, who's going to hold the keys, right? Are you going to self-custody your private holding? And the answer for about 99% of institutions, and it should be 99% of retail, is probably zero, is probably none, right? So there is a big technology need to enable wealth managers to be ready for the tokenization of traditional assets, but that means they have to understand how they can select and then allocate and then custody. And a separately managed account platform is where we're focused right now. So we've been working with a bunch of new prospects and clients to get that up and running, which is pretty exciting.
Where does the institutional community stand on accepting the risk of custody of digital assets? As you point out, once you start tokenizing assets, you have to worry about where is that loss point. And where is the level of acceptance in the institutional community at this point?
I'd say it's very low and early. Okay, so there's a lot of confusion when people say institutions. In my world, having worked at BlackRock, and coming from and this is a One River perspective, when we think institutions, we think asset owners, asset allocators, right? Well, it's the very largest pension funds in the world. It's the very large wealth managers. They have capital on behalf of clients and they're allocated to strategies. That's what we think when we say institutions. When you speak to many people in crypto, they think of hedge funds and mutual funds as institutions. Yeah. Now, what's happened is, for those entities, if you're a hedge fund and you want to be long and short Ethereum, you could go to a top-notch exchange, broker, custodian, as Coinbase is an example. Full disclosure, they own a piece of us, but you could go to them and for 1% to 2% of your portfolio, you look at those higher costs and they're not really a gating issue, right? But there's a big difference between saying that 1 to 2% of your portfolio has got somewhat higher costs that are difficult to see because the overall scale is small, right? And then saying, okay, what happens when we would like to tokenize all of these assets, right? What happens for the custodians? If they're traditional, how do the BIS rules treat it? A little bit better actually for tokenized funds, but there's some big questions, and ultimately, I think the answer is we're very early in that process. There are very few firms that are that you can really get comfortable with, right? I mean, how many companies are publicly traded with audited financials, right? Not that many. And at the end of the day, I think, especially when it's a bearer asset, right, that the bar for clients is just substantially higher, and the educational process for many of the kind of end clients, the end asset owners, it's been going on for a year or two, but we're still somewhat early in that process. And there's a big question as to, okay, what do we pick up in terms of flexibility and the auditability and potentially improved reporting, versus the cost today to doing it, and the risks, right? Are you worried about having your assets hacked out of State Street? Probably not, right? There's a reason for that level of comfort. The adoption of digital custody will eventually happen. Eventually, we think it's highly likely that you're going to see a better form of asset ownership take hold. But it's going to take a lot of education. And as the industry scales, by the way, the costs go down dramatically. So I think that problem solves itself, but it's going to take some time.
Yeah, just like the internet. Took an awful long time before the payoffs really began to manifest themselves. And isn't that one of the surprising things about, we're 8 years into Ethereum and many more for Bitcoin, 14, and we still don't see a lot of penetration into the real economy of this potential that blockchain-based business solutions have taken hold. And a lot of what you're talking about, laying the groundwork, is going to be the key to unlocking all that potential. I think digitization of assets is, maybe tokenization is probably one of the areas that will happen the best, but it'll take a while.
Yeah, I would just say, watch Polygon. So they're a scaling solution on top of Ethereum, and Polygon has a lot of momentum right now with large U.S. corporates, and you'll have to ask Starbucks, but they didn't have to choose Polygon to go create the next version of their kind of engagement platform, rewards. Like it's essentially a new version of a rewards network, but they did. So there's definitely an evolution happening in terms of how corporates are thinking about some of these platforms and what they now can enable. I mean, to be really clear, I think that the Ethereum, that Ethereum move to proof of stake, right? That unlocks a lot of engagement that you would not otherwise see. We have a lot of evidence and very specific examples, most of which we can't mention, but we know of companies that have just were going to do something on Ethereum, but then decided they couldn't because then they found out it was proof of work. It's now moved to proof of stake. You've removed a massive gating issue for the potential of crypto to be leveraged by many institutions, and that just happened, right? That is very recent. And we've been waiting for it for so long that we think it's priced in. And of course, in many ways, from an asset perspective, it probably has been priced in for some time. But from a behavior perspective and real ramping of new use cases on top of Ethereum, either directly on top or in many cases using a Polygon as one of the examples of a scaling solution, that stuff's just happening now. And this is a really chilly winter in terms of price behavior, but the activity that we see, and you've seen it at Crypto Mondays, the interest and the attendance has only gone up as prices have gone down. So this winter feels very, very different than I think others have done.
How about Avalanche? They also took an approach that was finding corporate partners and building joint ventures that had a path to regulatory supervision. And that sounded like a very smart business plan a while ago. Are they also making progress?
I just back up and say, look, all of the alt layer ones, right, had a very strong business case to when Ethereum was pre a couple of these various improvements, and you had, if you really go back, you had the gas wars where it became incredibly expensive to transact on Ethereum, right? So at that moment in time, Avalanche, Solana, a variety of other alternative layer ones had a big moment in the sun. I think we take a very pluralist view, and we recognize we don't know what's going to happen, but we know the competition is very good for the sector, and no one chain will be perfect for one use. We had, for example, Circle come and speak at the last Crypto Monday, and despite all the known issues around some of their uptime, Circle still went ahead and put Eurocoin, their new Euro stablecoin, on Solana. And so I asked, well, why would you do something like that, right? When you have Avalanche and you've got Ethereum, or you could do it on Polygon, et cetera. And they said, well, Solana is multiple times the size and speed of Visa with lower costs. So I think the reality is we don't know how things are going to play out for Avalanche, for Solana, and to remain humble and take an index approach, which is what we've done with our business, we think is really important. One or more of these assets that are not Bitcoin or ETH might have a return profile like Ethereum did when it first got going. And we just recognize we really don't know. Yeah. And we think the best approach is, just like we know in equities, to take a balanced, a balanced sort of index approach to ensure that we at least have some investment in the future.
Yep. And things go wrong that you can't anticipate, and new technologies come along that you can't anticipate. So it makes it a very treacherous. You don't want to make long-term single bets very often.
Well, definitely, and just to highlight, some of these assets could go from a 1% to 0% in our index, right? But they could go from 1 to 10, right? And if only one of those does that, and the other 9 go away, okay, so we're basically flat. But the likelihood, we think, is that this will be a growing pie, right? This is a very small sector in the end of the day now, given the decline in market cap. And we know that there's so much building happening and so many new use cases that are kind of popping up day by day, that it would be really, this is not the type of business where we have a high conviction that we can tell the future. So we're being very careful in terms of how we're building our systems, whether they're purely passive and taking a market cap or a size tilt approach, or even in our trend products. We're trying to be mentally flexible to understand that we don't know the future, and we need to let the data give us a sense of what might happen.
Well, Sebastian, this has been fantastic. Thanks so much for coming on. We've loved learning about One River Asset Management and your views on the market today. Listeners, if you'd like to learn more about One River Asset, you can contact them at oneriveram.com, or you can contact us at marketspolicy.com, and we can forward you on. Next week, we have John Linehan from T. Rowe Price, portfolio manager of the Equity Income Fund. And we hope you can join us for that. And if you have any feedback, we'd love to get it incorporated into what we're doing. Thank you very much for tuning in, and see you soon.